Well, thanks for joining us. I know it's a busy week, it seems, this week. It's our company convention, and things always seem to be a lot busier around the office because people want to get qualified, and I'm sure a lot of your agents are seeing that with companies they work with as well. So I have Todd Shields with me again. He is our disability products manager, and so he's going to help us out as we go through the disability products. So I'm going to go ahead and turn it over to him to get us started.
All right, thanks, Christy, and thanks everybody for their time today. Obviously, the first part of this we're going to talk about the disability income, and then the second half Christy will get into the critical illness portion. In the disability insurance world, not that it so much matters to you guys because it's really seamless behind the scenes, but we use two disability reinsurers. And one of those reinsurers, Munich, did this penetration study for us. And what we found are the columns in green are the number of people in millions in that stated category, and the columns in blue are the percentage of those people that actually own a disability policy. So you can see on the far left, there are not that many doctors and dentists, but about 80% of those people actually own a disability policy. And on the far right, it's the polar opposite. We've got over 100 million people sitting over there, and very few, if any, of those people actually own a disability income policy. So Assurity's focus is middle-income America. And as you can see by the red circle, this is really our target market. Okay? There's really unlimited potential. If you start asking the questions about disability income, very few, if any, of those people are going to actually have a policy. So you have a virtually unlimited amount of prospects that are out there. I'll talk about this in a moment. We just made some recent changes to the product, and I will tell you, while the red circle is our core focus, we are very competitive, and we have the capability of stepping outside of that red circle and those occupations to the left, and we'll go basically toe-to-toe with any of the other carriers that are out there. So we talk about, affordability of the product and the cost of doing nothing. Well, people might say that the premium is too much for them, and we know that people are spending $4 a day on Starbucks coffee. Well, for a quarter of that amount, or $32, they could actually protect their income, and as you can see in the small print below, we're talking about somebody making $60,000 a year in a 4A occupation class, so basically they have a desk job. We did age 65 benefits and a 90-day elimination period with an own-occupation rider. Okay, so affordability is really not the question. When we're talking about disability income, our goal is to try to keep the premiums between 1% to 3% of the client's annual income. Typically, if we're using a 90-day elimination period, which is the industry standard, and really our sweet spot, we're going to accomplish that goal. I'm going to touch briefly on simplified disability income. Basically, simplified disability income is a guaranteed renewable policy. It is a simplified application with simplified underwriting. Basically, the client will never go through paramed, blood, or urine. We don't need income documentation, and a lot of the moving parts from our fully underwritten Century Plus policy have basically been removed. Some basics about the policy: it's offered ages 18 to 59. We do use age nearest. They need to be working 30 hours a week or more, which puts them in a full-time status. We only use 2 occupation classes, and they're kind of flip-flopped from what you'll see everywhere in the industry. Class 1 would be more of the light duty or desk job type of people, and Class 2 would be more of a manual labor type of occupations. Benefits go anywhere from $300 to $2,500. It caps out at $2,500. Doesn't matter if the person's making $100,000 a year or more. Our benefit periods, we offer 6 months, 1 and 2 years. Typically, we see the 2-year benefit period being offered there, and elimination periods are pretty standard. We see the majority of those coming out of a 90-day elimination period. Built into the policy, it has a modified own occupation, so if they can't do their own job and they're not engaged in another job, that's their definition of disability. We do a partial disability on the back end, so they get 50% of their benefit when they start returning to work, even though they may not be working full-time. If they are approved for a social insurance benefit, workers' comp, Social Security, DI, we will reduce their benefit dollar per dollar by up to 50%. So let's say that the client has a $2,000 benefit, and Social Security comes in and pays them $500. We will reduce their benefit by that $500, so we'll pay them the $1,500. Social Security picks up the other $500. They still walk out with their $2,000 per month. Waiver of premium is included, just like every other disability policy. So as soon as they start we start making payments to the client. they are not responsible for their premiums anymore. And you can see the optional riders, critical illness, retroactive, and return of premium. They function the exact same way as they do on our fully underwritten product, and I'll talk about every one of those when we get into the Century Plus. But those are the 3 optional riders that they have. So it's a little bit of a stripped down policy, but like I said, simplified underwriting, simplified application, no paramed blood or urine, no income documentation. Keep in mind it's up to a $2,500 monthly benefit. I'm going to switch gears and jump into the Century Plus, which is really our flagship fully underwritten disability product. We'd already talked about, this is designed for middle income America. In the industry, Assurity is really known as a blue and gray collar carrier. While that is true, I will say that we are more than that, and that's a myth that I'm really trying to debunk, because 65% of our Century Plus applications are coming from our 2 best occupation classes, which are not blue or gray collar. Those are light duty and desk job type of occupations. We're seeing them from nurses, dental hygienists, CPAs, attorneys, other office workers. That's where we're seeing 65% of our applications. And with the 10 riders that we have available on the policy, you can really tailor a plan to meet the specific needs of every one of your clients. Some basics on this policy: it's offered ages 18 to 60, and we do use age nearest, so date of birth is important. The changes that I talked about on that very first slide with the market opportunities, this is where we've actually made some adjustments to our policy as of March 1. Our maximum issue limits based upon the client's occupation class now go from anywhere from $8,000 to $15,000 per month. In our 3A and 4A occupation classes, again, those are the light duty and desk job type of people, they will be able to get up to the $15,000. I can tell you that it takes $370,000 of income to max out our contract now. So we're talking about people making substantial money. We probably have the widest range of benefit periods of anybody in the market. We do a 1, 2, 5, and 10 years, you can see. We also do age 65 and age 67. Client's choice based upon their occupation class. Elimination periods are pretty standard. Again, from a sweet spot standpoint, we focus on that 90-day elimination period. That's really where we're best priced at, and again, that is the industry standard. From a benefit period standpoint, we see a lot of applications actually coming out of the 5-year benefit and age 65. What I can tell you is that even with the 5-year benefit, you're not doing your client any disservice. An average disability lasts about 2.5 years, so even a 5-year benefit period covers the vast majority of scenarios where somebody may be disabled. Everybody would love to have that age 65 or age 67 benefit, but the premium goes up when you get into those type of occupations or those type of benefit periods, excuse me. Take a look at that 10-year benefit period. You'll be surprised at the price break that you have regarding that 10-year benefit period compared to an age 65. You'll be surprised at what you see there. And when we think about it, 10 years for somebody to be disabled is a very long time. The last bullet point that I want to address up there is that the policy is set up as a guaranteed renewable contract. Now, this is not like a long-term care policy where we're going back every 2 years and asking for a 50% rate increase. We are in our 124th year of selling disability insurance through Assurity Life and our predecessor companies. And I can tell you that for the policies that Assurity has individually underwritten and individually priced in that 124 years, we have had 1 rate increase on a small block of business in California. While I can't say that your policy would never increase, I'm 99.9% certain that if your premium is set, it will remain that until the policy actually expires at age 65. So we've got a very rich history in the disability world. We know how to price these products, and we're doing an outstanding job of underwriting them to that pricing. So, like I said, while it is a guaranteed renewable contract, your client can be rest assured that those premiums are going to stay level. One of the things that we talk about, and we don't really get into policy language, but the definition of disability is really important for the fact that that's going to be one of the main questions that the client asks. Well, what does it take to start an actual claim? We're a little bit different, especially in the middle income market, because we do use true own occupation for the first 2 years. Basically, it says that in the red circle there, if they can't do the substantial material duties of their own occupation, they're done, their claim begins. if they basically, what it's getting at is that if the client can't do what they do on a daily basis, their claim would start. Now, where we're a little bit different is that other carriers add in the stipulation on the back end that the client may not be earning a wage or profit and remain on claim. You don't see that in our definition of disability. So we would allow the client to work in another occupation in addition to the money that they would be getting from our claim. This is a real story. A friend of ours was a 25-year-old ER nurse. She was driving back home from her parents' house and got hit by a semi-truck. And not only did she total her car, but she severely hurt her back. And after months and months of rehab, her physician came back to her and said, hey, you're never going to go back to work being an ER nurse or, because you can't lift heavy things and transfer patients. So she had to find another job. And she reluctantly took a job as an office manager at an auto body shop simply for the fact that she needed the income. Well, if she would have had an Assurity policy, we would have paid her claim for at least the first 2 years in addition to any other money that she earned from her office manager job simply for the fact she couldn't perform the job duties of an ER nurse. So that's really, really important. What I'll also mention is that after 2 years, you can see in letter D there, the definition changes up a little bit, and it says any gainful occupation. We're a little bit different than other carriers, too, because we use the word gainful. What other carriers say is any occupation, and that means anything that the client has been previously trained, experienced, or educated in. If they can do those jobs, they're done, they're off of claim. Well, by us putting in that word gainful, we've added an extra layer of protection for the clients that says that, okay, if you could perform the job duties of anything that you've been trained, experienced, or educated in, and those jobs would replace at least 60% of your prior income, then you go off of claim. If it would not replace at least 60% of your prior income, you remain on claim with us. So again, it's another layer of protection compared to what other carriers do. Here are the 10 riders that we have on the policy. I'm not going to talk about every one of these today. We don't have the time, and frankly, I don't want to bore you. But I just want to show you that we do have, again, that capability of customizing the plan to meet the specific needs of every client. I want to touch on a couple of key ones that you might want to think about including on every policy that you write. The first is the most common, but maybe the most misunderstood rider. That's the supplemental disability income rider. As you can see, it pays an additional benefit to the client, but that benefit is offset dollar for dollar by any of those 4 social insurance programs. Well, the question is, well, Todd, why in the world would I have my client pay for this rider if there's a chance that they may never end up using it? Well, good question, and I've got several reasons why you want to include this rider on your client's policy. If your client wants to insure their maximum income, you have to include this rider on their policy to obtain that total coverage, the total maximum coverage. Okay? If a client qualifies for a $5,000 monthly benefit, we are not going to put all $5,000 on the base benefit. Some of it will need to be included in this supplemental disability income rider. Another good reason is that dollar for dollar, okay, let's say we've got a $1,000 base benefit and $1,000 of the SDIR. Dollar for dollar from a premium standpoint, the SDIR is 30 to 50% cheaper. So it's a nice way to keep a policy cost effective for the client and get those premiums down. When we talk about the realities of those 4 type of social insurance programs, the likelihood of getting on those is pretty tough. You know, when we think about Social Security DI, they say you have to wait 5 months in order to even apply. And if you're not going to be disabled for a full year or die from that disability, it is not a valid claim for them. So their definition is very, very harsh. Only 35% of applications get approved on the first try, and typically we're seeing anywhere between 2 to 2.5 years for somebody to get on a claim if they get denied that first go-around. So we know that the likelihood of that is small, and Assurity is going to continue to pay out that benefit until they finally get approved. If they never get approved, they continue to get their full payment. When we talk about workers' comp, less than 5% of all disabilities actually occur at the workplace. So the likelihood of a workers' comp claim is pretty small as well. It is there to protect employees, and that's a great thing, but relying on that solely as income protection is not a very good idea. If they're not a government or railroad employee, they don't need to worry about the last 2. If they are, typically there's something that's built into their pension and they get some sort of a disability benefit, and then we would offset moving forward from there. So let me provide an example of how this actually works out. Your client has a $3,000 monthly benefit, $2,000 as a base benefit, $1,000 is in the SDIR. Claim begins, they start receiving their $3,000 monthly benefit. Social Security finally approves them for a $500 monthly benefit. So now Assurity is going to pay the $2,000 base benefit, $500 of the SDIR. Social Security picks up the other $500, and the client still walks out with their $3,000. The best way when I've done joint field work and talking with some of my own clients is that I will tell them, based upon your income, you have qualified yourself for a $3,000 monthly benefit in this example. You will receive the $3,000, and you will never receive less than the $3,000. The fact is that it could come from multiple sources. Some might be paid from Assurity Life. The rest might come from a Social Security DI claim. Or some will come from Assurity, and some might come from workers' comp. But you will never receive less than the $3,000 that you've been approved for based upon your income. We have a retroactive injury rider that I like to include on every policy. What this does is that if your client is disabled due to an injury or an accident, and they satisfy their elimination period, we're going to go pay it back and pay the base benefit back to day one. So in that previous example of the $2,000 base, $1,000 SDIR, if that's my policy and I've got a 90-day elimination period, I fall off my ladder getting the leaves out of my gutters, and I hurt my back, can't go to work. When I hit my 90-day elimination period, Assurity is going to take my $2,000 base benefit, multiply it by my 3-month waiting period, and cut me a check for $6,000 to go back to day one. So it really turns it into a 0-day injury elimination period. Like I said, I include this on every policy that I illustrate, but you can see the value, especially for those people that have more physical job duties, contractors, plumbers, electricians, roofers, that type of thing, where they're a little more inclined to be hurt on the job. This rider is very inexpensive. I don't think I've ever seen it as more than just a few dollars a month, and I've actually seen it as low as 14 cents a month. Include this on every one of your clients' policies. Another key rider we have is the own occupation rider. Okay, we talked about our definition of disability for the first 2 years. If you were to add this rider onto a client's policy, it will take that definition for the first 2 years and extend it to match the longer benefit period chosen on the policy. So back to my example of the ER nurse. If she would have had a policy with an age 65 benefit and an age 65 own occupation rider, because her physician told her that she would never return to work being an ER nurse ever again, we would pay her claim all the way from age 25 to age 65 in addition to any other money she could earn, as long as she wasn't able to go back and do the job duties of her ER nurse. Okay? She would have been able to double dip for 40 years in addition to any other money she could have earned. Not a bad deal there. I will tell you that this is only available for people who fall into a 3A or a 4A occupation class. Okay, again, the light duty or the desk job type of workers. And the question I get is, well, when do you add this to a policy? Do you do this for every 3A and every 4A? And I say no. I would not put this on my own policy. And I get people looking at me kind of cross. And then I explain why. Well, when I think about my specific job duties, I do travel, but the majority of my time is spent at a desk, typing, talking, that type of regular desk job type of work. Everybody knows what that's all about. If I can't do those job duties, what can I really go out in this world and do? Probably not a lot, right? Okay. Think about somebody with specific job duties, though. What about a dental hygienist? What happens if that dental hygienist gets carpal tunnel or arthritis? They can't hold their tools anymore. They're done. Okay. They have specific job duties. They could get paid that entire time, in addition to other money that they could possibly earn. I will tell you that this rider does add some premium to the policy, but for the extended benefit and the peace of mind that they're going to get knowing that if they can't do whatever they're doing, they're going to get paid that entire time, it's well worth the premium. We also have a catastrophic rider, and ours functions a little bit differently than other carriers out in the market. Ours says that if the client loses 2 of their 6 activities of daily living, we will pay their base benefit all the way out to age 65 for them. So we'll end up paying their normal claim out. Let's say they've got a 5-year benefit period. And then we're going to take that base benefit and we're going to pay it all the way out to age 65 for them. Okay? Other carriers pay an additional amount, and then whenever their benefit period ends, so does the catastrophic rider. Our thought process is If a client has lost 2 of their 6 activities of daily living, are they going to really regain those? Probably not. And this allows the client a stream of income until they reach age 65. Again, this rider is also very inexpensive. I don't think I've ever seen it more than $3 or $4 a month. I see this being added in a couple of scenarios. One would be for the people that fall into a 1A or 2A occupation class because they can't get the longer benefit periods based upon their job. This provides a level of protection for those people should something severe happen to them. Or I see it being added to other policies. Maybe they could qualify for an age 65 or the age 67 benefit period, but they don't want to pay the premium for that option. Again, if something severe happens, they've got a stream of income. I'm not going to get into a lot of the critical illness on how this functions. Otherwise, I'm going to be taking up a lot of Christy's stealing a lot of her thunder when she goes to explain how this works. But I will tell you that our critical illness rider functions the exact same way that the standalone critical illness policy does. We have 9 covered conditions. The simplified actually has 12, and the fully underwritten has 21. But the big 3, the cancer, heart attack, and stroke, are covered with this critical illness rider. And it's as simple as checking the box. Okay? We will check family history to make sure that mom, dad, brother, sister have not had 2 or more of these incidents prior to the policy being issued. But it's really as simple as checking the box. And what we will do is we will go 36 times the base benefit up to $150,000. So they can get substantial amounts of critical illness benefit, and they're using DI underwriting standards to get that policy as well. What I like to say is that the critical illness really complements a disability policy extremely well. If you think about the analogy of the disability policy being the brakes on the car, everybody's got to have brakes on a car, right? Well, the critical illness is there as the airbag for that sudden stop. And I'll let Christy cover here a little bit later in the presentation today how the critical illness plan actually works. But again, it functions the exact same way as the standalone. It just does it in a rider capability. One of my other favorite riders is return of premium. And our return of premium is based upon issue age. If the client is ages 18 to 44 at time of issue, and they can keep their policy for 25 years or more, we will return 100% of their premium minus any claims that we've paid out. If their issue age is 45 to 55 and they can keep the policy 10 years or more, we will pay 50% of their premiums back to them minus any claims that we've paid. Now, return premium, I will tell you, is our most expensive option that we have. It will about double a premium on a policy. But the way that I like to show this, and we can get into this in another session, is I like to show return of premium through a time value of money calculation. And if you can show them, here's why spending the extra money for the return of premium rider is beneficial, because this is what you get back, and you put that through the time value of money, return of premium comes back to the client on a tax-free basis. And we're seeing tax-free equivalent returns of anywhere between 4 to 6.5%. Well, if the client were to put that in a taxable investment, they would need to get anywhere between 6 and 9, sometimes more, depending upon their tax bracket, return each and every year. And what is the likelihood, especially with our economy right now, that may end up occurring? Like I said, we can cover that whole presentation another time, but that's kind of my spiel on return of premium as far as how that works out. Another big question is, well, what in the world does it take to get through underwriting? Well, we use a traditional approach, and by that, all I mean is we're going to do background checks for motor vehicle, prescription drugs, and MIB. We're going to take a look at their occupation, but more specifically, their job duties. We don't really care what their title is. We want to know what they do on a daily basis and what percentage of time they end up doing that. Obviously, we're going to look at their income, and really what it comes down to is if they're a W-2 employee, we're going to go off of gross. If they're 1099 or self-employed, we're going to be using net income. And then obviously we're going to be taking a look at their health history. Now, based upon that information, underwriting can offer coverages with ratings, exclusions. We can change the elimination or benefit period if we need to. I will tell you that underwriting would rather make an exclusion than rate a case. So it's not like a life insurance policy. We would rather just exclude a condition and leave their premium level as it is. In the last 2.5 years, I think I've only seen one disability policy rated, and it was because the client had an extremely poor driving record. They were getting pulled over what appeared to be about every other week. One of the cool things that we can do is the third bullet, the last bullet point there, is the modified coverage amendment. Basically, if somebody's had a bit of a pre-existing condition, in my example, let's say it's shoulder surgery, okay? Let's say I had that shoulder surgery 5 years ago. I'm back to work, clean bill of health, no reoccurring issues, everything seems to be okay. Well, underwriting is going to know that there's been some damage to my shoulder and I've had it repaired. But instead of totally excluding my shoulder because I'm back to work and everything is okay with a clean bill of health, they could say, well, Todd, you've applied for a 90-day elimination period and that 10-year benefit period. And we're going to give that to you except for your shoulder. For your shoulder, because there was pre-existing damage there, we're going to do a 180-day elimination period and a 5-year benefit period. So it's still a covered condition. It may just take the client a little bit longer to start making the claim, and we may not pay that claim for quite as long. But it is still a covered condition, and that's something that is really beneficial because we're not just totally making exclusions in certain scenarios. I want to talk really quick about our non-medical limits and our income verification. At the top is our non-medical limits, and for clients ages 18 to 50, which would be the vast majority of disability clients, we will go up to $3,000 of benefit on a non-medical basis. Okay. Above that, any amounts above that, we're going to ask for paramed blood or urine. So think about $3,000 of benefit. That's somebody making between, if they want to insure their total income, $52,000 to $54,000 a year, typically in that range. Now, maybe somebody is making a lot more money than that, and maybe they only want $3,000 of coverage to pay their mortgage and their car payment. That's absolutely fine. As long as they're only applying for $3,000 or less, they could still get non-medical. When it comes to income documentation, if they are not self-employed, okay, a W-2 employee, that same $3,000 or less, we don't ask for any income documentation. If they want more than the $3,000, they get their choice of 2 pay stubs, a W-2, or their tax return, whatever is easiest for them. So for W-2 employees, it's very cut and dry, very simple. It gets just slightly more complicated for those that are self-employed or 1099, okay? $2,500 of coverage or less, we don't ask for anything. If they want more than $2,500 and they're asking for the shorter benefit periods, the 1, 2, 5, or 10 years, we're going to ask for 1 year's worth of tax returns, business and personal. However, if they want an age 65 or an age 67 benefit and they're asking for more than that $2,500, we want to take a look at 2 years worth of tax returns for that client. And what we're going to do is we're going to average those two things together. Basically, underwriting wants to make sure that the client has steady income. They don't have a huge spike, and they're trying to get benefit based upon, one really good year. One of the programs that we run for Century Plus is what we call a one occupation class upgrade. And for your clients that have been business owners for at least 3 years, their last tax return showed a net income of at least $30,000 and they own 10% of the business, we will bump them up a full occupation class. What I like about this program is that the agent does not have to specifically be looking for this or ask for it. If they miss it or they're unaware if the client would qualify, as soon as our underwriters know that the client has met this criteria, they will automatically bump them up an occupation class for you. The other thing that I like about this is that every time somebody moves up an occupation class, they're saving 25 to 40% on their premium. Okay, so it's substantial savings for these clients. And you can see the second bullet point there, and this is really awesome for people that fall into a 2A category. Now they can get that own occupation rider, and they can get those longer benefit periods that they weren't eligible for in the first place. I dare you, okay, I know because I know that this can't happen, but show me another company that will take a landscaper doing the job duties, laying the sod, digging the holes, all that fun stuff, and give them an age 67 benefit with an own occupation rider all the way to age 67. It's not going to happen. This is the type of program that we use, and you can get clients that do some more of those physical job duties and are the owners a very robust policy. You can see that the only occupations that we won't do this for are people that fall in the medical field, farmers, and roofers. We have about 30 occupation-specific brochures sitting in our little warehouse downstairs. So if you or your agents want to target specific clients in a field, we probably have those occupation brochures already made. This is a great way to target those type of clients. If there are occupations that you guys want to target and maybe we don't have available for you, please reach out to Chrissy or myself and let us know, and we'll work with our marketing department to get those made up right away for you. But I would venture to say that in a lot of the scenarios, we probably already have those made for you. One of the most powerful tools that we have, which is out on our website, and we can actually get you copies if you need copies of it, is our DI illustration checklist. This looks, I know you can't really see what's on here, and that's fine. What this is going to do, it's going to do several things for us, actually. First, we're going to find out the job duties of your client. That way we can get you an illustration in the right occupation class. It's going to find out how they're earning their money. That way the illustration can be made with the right benefit amount. And the rest of the things on there are some generic health questions. These aren't all knockout type of questions, but these are things that will hold up a disability policy in the underwriting area. You know, your life insurance underwriter is not going to care if your client's seeing a chiropractor, but our disability underwriter definitely will want to know that type of information. Okay. This takes 3 to 5 minutes to fill out with the client. And what I will tell you is that by taking that time, you are putting money directly into your pocket, because we have tracked agents that use this versus agents that don't. And the agents that use this illustration checklist place 20% more of their cases. Okay? Take 3 to 5 minutes of your time before you fill out the application, and let's get the pre-screen done for your client. One of the other things that you're doing is you're setting the expectation with the client up front. Hey, if they're seeing a chiropractor, we can basically tell you what's going to happen to their policy in advance. That way the agent doesn't have to sell that policy on the back end because maybe it has a modified coverage amendment or an exclusion on the policy. Like I said, it's just such a powerful, powerful tool, and I would use this at every opportunity that you can. So with that, I will open it up to you guys for any questions regarding the disability portion, and then I'm going to turn it over to Christy to tackle the critical illness section. Are there any questions that you guys have?
All right.
Well, if you think of anything, please reach out to Christy or myself and let me know. My email address is tshield@assurity.com, and my direct phone line is 402-437-3559.
And we'll send a new contact sheet over to Nick to share with you guys as well. So if you do need to get a hold of us, that'll all be available for you there as well.
Sounds good. Thank you guys so much for your time, and have a great rest of your week. Oh, sorry, go ahead.
Nick West here. I think about every single person on the call has asked for, via instant message to me, the slideshow. Is that something you'd be willing to share?
Yeah, definitely. Yeah, we can share
Absolutely.
that. We'll send it over to you. Definitely.
Okay, excellent.
Were there any other questions that you got on IM, Nick?
No.
Okay, all right, fair enough. Have a great rest of your week, guys. Look forward to speaking with you more.
All right. Well, Todd covered one important part of, all of your agents' plans working with their clients, and I'm going to hit on the critical illness. One of the things that we try to incorporate in our sales presentation for you guys, beyond the underwriting aspects of that, and the basic product information is, really hitting on some of the sales things that you can share with the agents as well to help with that business. So with critical illness, there's a lot of people who have heard of this now. There's about 20 different types of policies out there that have some type of critical illness benefit. But there's a couple things I think that are very important with you working with your clients, especially after everything that's gone on with the healthcare reform. A lot of those clients are going to be a little hesitant to do anything that, even remotely looks like something associated with a health policy. And, a history of critical illness, as many of you probably already aware of, this was created by Dr. Marius Bernard, did that first ever heart transplant with his brother in South Africa. The product has been around for a while, but the thing that I want to point out the most about this for you guys to share with your agents is doctor, doctor, doctor. really reiterating to those agents to share with their clients that this product was created by a doctor. The big thing there is it's not saying, the insurance company didn't have any involvement. Obviously we have to have our actuaries price out things and, do all that set up, for those premiums. But the concept was not thought of by an insurance company. And why that is so important for your agents to share with the clients is, if the insurance companies were to come up with a concept of how this plan would work, we would have many, many, many different strings attached to it. Being able to decide how we want that benefit to pay, the claims process, would be a lot more difficult than just sending in a copy of doctor's reports. We'd want to have people who would consistently be evaluating our process if we're, determining, and, what's the one thing for the consumer is they always see the insurance companies as their #1 enemy. So with this CI plan, it's very important for them to understand that the concept of this product was brought up by a doctor. So I'd always like to reiterate that, for any personal business I write myself, that's the very first thing I tell any of my clients. And, I've actually claimed on critical illness. That's not the story I start with. I start with a doctor because I think that kind of helps take down one of those barriers for an agent right in the beginning that the client has already put up because it has, insurance in it. And that's just it's a bad word for a lot of people. So 4 questions for your clients to use in the meetings. Do you know anyone who has ever been diagnosed with a heart attack, stroke, or cancer? The big thing with this is getting them to have that person in their mind as your agents are going through their presentations. Same with you if you're working with agents, trying to get them to see the value of CI, get them to think about that person as well. Next, we want to know, did they plan it or was it unexpected? Well, we know no one plans on, today I'm going to go to the doctor and get diagnosed with cancer. No one plans on that. If anything, it's the complete opposite. Someone who, I'm really healthy, I'm young, that's never going to happen to me. That's the kind of planning that we do, which, we know we can't really predict. Was there unplanned emotional or financial strain on the household or business? As Todd had mentioned with the DI, our target market really is that middle-income America. And if you think about the average middle-income America family, they're living paycheck to paycheck, or putting a little money away in savings, but not a ton. And so with that, it's really important to think about if your client were diagnosed with cancer, had a heart attack or a stroke, how would their life be affected? If right now, if they're already kind of going paycheck to paycheck, even assuming your clients have that disability policy, so we have something there to help out. But thinking about the fact that maybe there's $50, $100 left after that paycheck comes through, how are they going to deal with a critical illness situation? It's going to be really difficult for them. Marius Bernard in his book has a story, and when I read this book, I think it's one of the most emotional stories for why he came up with this product. But I think it's really important to think about for that unplanned event. He had a patient of his who had end-stage cancer, and the times when she should have had a little more pep to her step, when she was kind of close to getting ready for one of her chemo treatments, her body's a little more recovered. When she was coming for her checkup, before they could do a chemo, he would realize that she still was really run down, really tired, really stressed. And so he had asked her the one day, why, what else was going on in her life, or what he could do to help get rid of that stress for her. And come to find out, this was a single mother of 2 boys, and this is all unplanned, obviously. She was their sole caregiver, and while she was dying of cancer, she was still working a full-time job to keep a roof over those children's head. And thinking about that, and this is another good one for you to use with your agents to use with their clients. how would you feel in that situation? You probably would do the same thing. You want to make sure your family is protected. But at the same time, on the other hand, by her having to do that, she wasn't able to, create some of those memories with her children, those happy memories, because, whenever she wasn't at work, she was just exhausted. And so, it's really important to think about the unplanned emotional strain that does come up, whether it is finances, even someone who has money, there still is a lot of that strain. And anything that you can have set up there for your clients, for your agents to share with their clients, that's going to be a huge way to help them to continue that sale process with their clients. Would cash have helped? Again, we know cash isn't the solution to everything. Having cash is not going to help us to find a cure for cancer, reverse the effects of a stroke. But again, we're looking at that emotional sense of giving that client a little more independence and not having to worry about, what bills that they need to figure out which one's the more important one to pay this month. So the three realities of health, and this is why we're looking at CI now. As that slide with Dr. Bernard, the product has been available, for quite a few years now, but really is starting to pick up momentum in the U.S., here in the last 3 to 4 years. Assurity, we've had the product for a little over 10 years now, and again, just starting to pick up. Now, the realities of health of why this is happening and why we're looking at this now, these things do happen a lot. We see that incident. You go into a gas station, you see that jar there, we're collecting money for, little Susie Q, who is going through leukemia treatment. Her family needs a little help. We have that pancake feed or spaghetti feed, for John Doe, who just suffered a stroke and his family needs help, to make some modifications to their house, take care, have a nurse coming around. Things happen, and we hear about them all. The good news is, though, again, since we're having those fundraisers, having those spaghetti feeds, people are living through those conditions. We're not dying where we used to be. For those of you who have been in the insurance business for a while, we look at term insurance rates. Those used to be pretty high premium, but, here in the last 10 to 15 years, they've decreased dramatically. And the reason for that is there's not a lot of people who claim in that term anymore. If someone's diagnosed with a critical illness, they're not as likely to pass away as they were, 15, 20 years ago. Just to give you an idea, a client who has a heart attack even, we think right away then, well, they're going to have issues the rest of their life. Well, we know that's not the case. We all know someone who has suffered from some kind of heart problem. But, the other thing to think about, even with that disability policy, for the average patient who doesn't have a lot of extreme side effects, they're in and out of the hospital within 5 days. Able usually to go back to work within the next 30 days. Chances are they're never going to qualify for disability. So, but they're still having that huge impact on their life. Maybe they're having to cut back their hours. Maybe with the job they have, they're a truck driver. They're no longer passing those tests anymore, in order to be able to get behind the wheel of that semi. So they're surviving, but there's consequences on their life. Whether it's a small one or a big one, it still is that consequence. And thirdly, the reality is it's usually the most healthy person who's going through this. The reason for that is, they're healthier, they're easier to rebound back from that sickness. That stroke, we can, a lot of times they can reverse side effects within 96 hours. We actually had a claim here, actually up in the Omaha area from a 34-year-old woman who had a stroke. Thankfully, she's doing fine, very minimal side effects today. But one of the biggest things they say that really helped was that she was healthy when that happened. Now, if it would have been, 50 years later, and, she's not as healthy, not working out every day like she had been, there's chances are that may not have that same end result. And, again, it's the healthier people you hear of, the ones that are having the most success, you could say, with having a full recovery from a critical illness. The big thing with the agents too is not talking about, I'm going to give you $50,000. It's not cash for cancer. Talk about what the product actually does. You want to give them some uses so they can see that value. So just to give you an idea of some of the different things the policies here at Assurity can be used for, again, it's not limited. If someone has a claim, we're paying out that benefit, and they can do whatever they want with it. You can see on here just a few things. One of the things I like to point out the most, I think, and this is something I caught myself doing, in my recovery from cancer, is down here towards the bottom on the right side, taking stock and catching your breath. Someone who has gone through that heart attack or stroke, even if they do get back to 100% or going through chemo treatments, they get back to, where we're done with everything, it's time to go back to normal life. The big thing there is being able to take some extra time off and just relax. Regress, reality that you survived through an illness. And that's one of the biggest things you see there, because people, again, that worry about money, worried about getting back to work right away to start getting that paycheck again. This is probably one of the biggest benefits, I say, of these policies. So we have two different products, and kind of like Todd did, I'm gonna go over some of the details of the products and then go or break down that underwriting a little bit for you as well. So we have a simplified plan that covers ages 18 to 64. We are 59 in the state of California, I know that. Benefit amounts in the simplified are $5,000 to $50,000. We have 12 different conditions covered, and I'll go over those here in just a moment. The policy is renewable to age 75, so once the clients do reach 75, the policy will expire. And riders available, we have that return of premium. We have the disability waiver, accidental death, and then we have options for those that have a family and want to include spouse or children on the policy. Now, the way our plans work is we're in a three-category approach. The first one is going to be your cancers. Second is going to be your cardiac. And third is going to be miscellaneous conditions. So let's say you sold a client, or one of your agents sold a client a $50,000 policy. Let's say at age 35 then, that client was diagnosed with cancer. Once we get the claim paperwork in and we get a copy of that pathology from the doctor, we're going to pay out that $50,000 benefit to the client. Let's say things go back to normal, 10 years later, the client has a heart attack. Again, once we get that claim paperwork back in and get a copy of the statement from the doctor stating that the client had a heart attack, we're going to pay a second benefit of $50,000. So as of then, 10 years down the road, the client has now received $100,000. So worst case scenario, let's say the client at age 70 gets diagnosed with advanced Alzheimer's. We're going to pay a third benefit of $50,000. So all in all, that $50,000 policy that the client has been sold actually has the potential to pay up to $150,000 of benefits. For the clients, again, that don't really see the need, one great thing that we have built in on this plan as well on the fully underwritten is, let's say the client were, to walk out across the street and get hit by a bus today. It does have a built-in return of premium on death at no extra cost that's built into the policy while the policy is in force. Fully underwritten, we're gonna have a little bit higher amounts here. You can see the issue ages are going to be the same. We'll go up to $500,000 of benefits. Cover conditions also, we've added 9 more conditions under the fully underwritten plan. This one is guaranteed renewable for life. So your clients can keep this as long as they stay paying premiums. We're going to have the same riders on here, that waiver and the accidental death, children and spouse. However, we do not have a return of premium rider on the policy since the plan does go for life. Here you can see the cover conditions. That cancer category is going to stay the same. We're going to add a couple more conditions into that cardiac category and quite a few more conditions in that third category. Now, one thing I wanted to explain to you too is you can see on some of these, they do not show 100% payout. So as an example, let's say you have a client who has been having some heart issues. they go in and they actually have a stint put in. We're going to pay 25% of that benefit. They still will have 75% of that benefit left in that category too. So potentially wherever there is a 25% benefit on here, the client potentially could claim twice in that one category until they've reached that full 100% of the benefit. Now, underwriting on these plans, I think it's a pretty simple process. The nice thing, unlike DI, is there's not a lot of moving parts, so it's a lot easier for those underwriters to review. The simplified plan is going to be accept or reject based on the application. The biggest health question on both of these products is that the client's ever already been diagnosed as having one of the covered conditions. If that's the case, they're not going to be eligible for the product. A few places I've seen exceptions on the fully underwritten. I know we recently wrote a client who actually was born and was missing two limbs, was missing both of her arms from elbow down. She was born that way. Those kind of things we're able to exclude on the policy, once we find out kind of the story behind it. So there is a possibility that depending on a few of those conditions, but anything, in that Category 1 or Category 2, there really is no exceptions there at this time. EAP, though, available for both products. That's simplified with that 4-day service guarantee. One thing I will mention on the simplified, just I think it's an important thing too, during underwriting. Let's say, for instance, we're running that same script check, we're running that MIB. If something does come up that is questionable, instead of just saying, well, since this is accept or reject based on the application, let's just toss this one away, we actually have a team of in-house phone interview people available. And so what they'll do, we always want to try to offer something if we can. We may set up a phone interview for your client just to verify some information if we can go ahead and take them for the simplified plan. So pretty easy process. Most of these cases we see come in, especially on the e-application, within a day and a half we'll usually have an answer. When we get into summertime months or whatever holidays, that will hit more of that 3 to 4 day period just because of staffing for holidays and vacations. For the fully underwritten plan, this one is going to be a little more difficult. It's going to be very similar to preferred life underwriting. Two of the big differences I see from that preferred life is the bill chart. The bill chart is a lot more flexible on the fully underwritten plan than a preferred life case. Secondly, in that fully underwritten plan, family history becomes a little more important here. Now with that, the one thing we always think about is genealogy, what kind of things is someone passing on in their family. Well, let's say, for instance, we have a female wanting to apply for coverage, and let's say she has a mother and a sister, so 2 first-degree relatives that have both had breast cancer. Just looking at the family history there, most cases there we're going to decline her for coverage just because we see that carries on in the family. Now, if we have that same client applying and we have a father who has had prostate cancer and a mother who has had breast cancer, that's not going to be an issue because those two conditions are not tied together. Same with, if you were to have, a client had a stroke and, the other parent had a heart attack, again, they're not two related conditions, and so that won't affect the underwriting. It's only when we have 2 or more first-degree relatives. So, again, that's just going to be siblings and parents. We do get a lot of questions on this about families that have adopted members, how that works. If the client has no way to know their family history, we can't hold that against them. So, that the family history is not an issue on a client that has been adopted, because we know we can't find out that information.